This is the part of property investing most people ignore, but it's also the part that can cause the biggest problems later. Most investors spend a lot of time thinking about how to buy a property. They look at the numbers, the rent, the mortgage, and they try to work out if the deal even makes sense. Very few people ask this simple question: who am I going to sell this to? And that question matters more than people realize, because not all properties are equal when it comes to exit. Some are easy to sell, some are much harder, and that difference affects both your flexibility and your risk. I've seen deals where everything looked fine whilst the investor owned it. The rent was coming in, the property was performing, and on the surface it looked like a good investment. But when it came to sell, that's when the problems started, because the buyer pool was much smaller than expected, and that limited their selling options. Let me explain what I mean. If you buy a standard house, you usually have a wide market. You can sell to homeowners, you can sell to investors, there's demand from multiple directions. That gives you flexibility. Now compare that to something like a HMO. You're not selling to a homeowner, you're selling to another investor, someone who understands the model and is comfortable with the setup and is happy with the yield. That's a much narrower market. And if investor demand slows down or lending becomes tighter, your exit becomes more difficult. The same applies to certain flats, especially if there is high service charge, short leases, or leases with the building. Even if the property performs well while you own it, those factors can affect how easy it is to sell. When I analyse a deal, I look at exit early, not as an afterthought. I ask, who is the likely buyer? How big is that market? And how sensitive is the value to change in those conditions? Because a deal that looks good today can become much harder to exit if the market shifts, or should I say when the market shifts. And that is the key point. You're not just buying a property, you're buying your future options. The wider your exit options, the more control you have. The narrower your exit options, the more exposed you are. That shouldn't mean you should avoid deals with narrower exits, but it does mean you need to understand what you're taking on and price that risk properly. Because this is where a lot of investors get caught out. They focus on getting into the deal, but they don't think about how they will get out. So if we take one thing from this whole video, it should be this: always think about the exit before you commit. Because a good investment isn't just about how it performs whilst you own it, it's about how easily you can move on from it when you need to and when you're ready to. Thank you so much for watching today's video. I look forward to seeing you in the next one.